So, you want to buy a bank. Most people think owning a bank means buying a building, hiring tellers, and installing a vault. That's roughly true, except before any of that, you will need to pay a visit to the federal agency that regulates the entire banking industry in this country, the FDIC.
Wow!
The Federal Deposit Insurance Corporation. In plain terms, it's the government body that guarantees a customer's money won't disappear, even if the bank itself goes under. And the first thing it'll tell you is that you need to have at least $20 million of your own money on hand. Of course you have that, but the exact amount depends on which state you're opening the bank in and how competitive the local market is. In a major city, the FDIC may ask for more. In addition, you'll spend another $200,000 or so on lawyers to prepare your application for a banking license. Another $300,000 will go toward consultants and market research. Speaking of the application, you'll be putting together a document called a banking charter, somewhere between 800 and 1,500 pages, describing every aspect of your future bank. Regulators will study it for 18 to 24 months. If you're approved, you walk away with what is arguably the most valuable license in the United States: the right to take other people's money for safekeeping. Now, you might be wondering, is there a faster and cheaper way in? Like buying an existing small bank instead of starting one from scratch. There is, and honestly, it's the smarter route. In January 2025, California-based Plumas Bancorp bought Cornerstone Community, $658 million in assets for $64.6 million. Smaller community banks usually trade 1 to 1.5 times book value. $200 to $300 million would run you around $40 million. For that, you walk away with customers, a license, branches, trained staff, and no 2-year waiting line. In Europe, the entry is even cheaper. There, you can get a specialized banking license for around 5 to 10 million euros in regulatory capital, which is exactly why almost every young European fintech startup started there before expanding anywhere else. But Europe has another advantage. The banks there get robbed a lot less often. In the United Kingdom, there are about 100 bank robberies a year. In the US, in 2023 alone, there were 1,362. That said, even in the States, this statistic isn't the problem people imagine it to be. Over the past 20 years, bank robberies have dropped by 80%. Strange as it sounds, being a bank robber has stopped paying. The average amount taken from an American bank is around $5,000, a long way from the millions you see in the movies. And if your future bank does end up getting robbed, remember that FDIC cushion we talked about earlier? It's not used here. The FDIC only covers customer deposits, and only if the bank fails completely. Robberies are covered by a separate mandatory policy called a banker's blanket bond. Basically, theft insurance for banks. The insurance company pays out the full stolen amount and then decides on its own whether to chase the thieves. The teller at the counter is specifically trained to hand over whatever is in the drawer with zero resistance. Because the cash is insured, their life isn't. So, put it all together. $20 million in capital plus 2 years of paperwork to start your own bank from scratch, or $40 million to buy an existing one. Either way, you're stuck with mandatory insurance, layers of compliance, regulators in your books every quarter, and a stack of fixed costs that don't care whether your bank is making money or not. So the question becomes obvious. Why would anyone in their right mind go through all of this? The answer is simple. When you deposit $1,000 into an American bank account, the bank doesn't put that $1,000 in a vault. It doesn't have to keep it all on hand. In March 2020, the Federal Reserve, the American central bank that sets the rules for the entire banking system, quietly eliminated the reserve requirement altogether. Before that, banks were required to hold at least 10% of your deposits in a special account. Now, the formal reserve requirement is 0. That does not mean banks can ignore capital and liquidity rules, but it does mean your $1,000 is not sitting in a special reserve box waiting for you. When the bank lends that money to someone else, say a $200,000 mortgage to your neighbor, it doesn't pull your $1,000 out of a drawer. It just types $200,000 onto your neighbor's account. That money didn't exist a second earlier. The banking system gives licensed banks the authority to create deposit money like this, as long as the bank stays within capital and regulatory rules. Banks create money every time they issue a loan, and that money disappears when the loan is paid back. After that, the bank collects interest on a loan it created itself. Here's how it looks in actual dollars. The customer keeps $10,000 in their savings account. The bank pays them $50 a year in interest, the standard 0.5%. Then the bank takes that same $10,000 and lends it to someone else as part of a mortgage at 7%. The borrower pays the bank $700 a year. The customer gets $50, and the bank pockets the $650 difference on money it never actually had to come up with. Across the whole bank, this gap is called the net interest margin. For a small American bank, a realistic number is around 3.5% to 4%. Multiply that by every account in the bank, and that's where the real money is. For JP Morgan, with $4 trillion on its books, this gap brings in roughly $100 billion a year in interest income alone. The bank makes that kind of money because it has the most valuable resource in any business: data on its customers. It knows where they live, what they earn, and what they spend it on, which is exactly why every other industry is desperate to get hold of the same information. But the lending side is only half of the business. The other half is the credit card. Americans currently owe $1.25 trillion in credit card debt. The average interest rate on those balances sits at around 21%. To put that in context, the Federal Reserve's own benchmark rate is under 4%. Banks are charging their customers more than 5 times what it costs them to access the same money. Imagine your customer carries a $5,000 balance on their card. Every month, they're told the minimum payment is around $100. Sounds responsible, easy to handle. But at 21% interest, about $90 of those $100 goes straight to interest. Only $10 actually pays down the debt. At that pace, The $5,000 balance takes about 30 years to clear, and the customer ends up paying around $7,000 in interest on top of the original $5,000. This works because almost nobody pays the full balance every month. Roughly half of all American cardholders carry a balance from month to month. In 2023 alone, major card issuers collected an estimated $25 billion in additional interest, just by raising their margins above what their own borrowing costs would justify. There are also cases where bank owners took this much further and built revenue streams that nobody would put in a presentation slide. In 2010, Wachovia Bank, the fourth largest in the United States at the time, admitted in federal court that its anti-money laundering controls had failed. Money tied to Mexican currency exchange houses had been moving through its systems for years. The total came to more than $420 billion. The cartels would bring cash from drug sales back into Mexico and deposit it at casas de cambio, local currency exchange shops. Those shops then wired dollar amounts into accounts in Miami, made to look like ordinary money transfers from Mexican workers sending wages home. From there, the bank moved the money wherever the client wanted: aircraft for transporting drugs, real estate, or legitimate businesses. Wachovia collected a fee on every transfer and never once flagged any of it as suspicious. The fine Wachovia paid was $160 million. Not a single employee did time. But to be honest, you might end up with problems just as bad, even without dealing with cartels. On March 8, 2023, Silicon Valley Bank, SVB, the 16th largest bank in the U.S. with $210 billion in assets, announced that it urgently needed to raise capital. 2 days later, the bank no longer existed. 40 hours. That's the new world record for the speed at which a bank can disappear. SVB served roughly half of all venture-backed startups in America. The moment the news of the bank's trouble started circulating in private founder chats, depositors began pulling their money out. In a single day, $42 billion left the bank. In the old days, a bank run meant people lining up at the teller window, which gave the bank time to react. Now, the whole thing happens on a phone screen. By the way, the CEO of the bank, Greg Becker, sold off $3.6 million of his personal shares 13 days before the collapse. Funny coincidence. What happened to SVB is called a bank run, when customers all show up to pull their money out at the same time, and the bank doesn't have anything to give them, because the bank's actual cash on hand is small, and the rest is locked up in loans that people will be paying back for the next 30 years. There are a few rules you have to follow to keep your bank alive longer than 40 hours. First, keep your depositor base diversified. SVB died precisely because 89% of its clients came from the same industry and personally knew each other. Second, be careful where you park your customers' money. Banks don't just sit on deposits, they invest them. SVB took its short-term deposits and bought long-term U.S. government bonds. When interest rates rose, those bonds lost value, and when customers showed up wanting their money back, the bank had to sell them at a massive loss. That's what set off the panic. Third, watch who you're lending to. In 2023 and 2024, hundreds of regional banks came within an inch of bankruptcy after issuing commercial mortgages on office buildings. When everyone shifted to remote work, offices emptied out, tenants stopped paying rent, building owners stopped paying their mortgages, and the banks were left holding loans against half-empty buildings worth a fraction of what they were a few years ago. And one last thing. The man with a gun is a Hollywood cliché. The real losses come from the person already in the office. Roughly 60% of all the money stolen from American banks over the past decade was stolen by the bank's own employees. The loan officer writing a fake mortgage to his wife, the teller who's been slipping $100 out of the drawer for years, or the IT guy with system access. Banks have never been a safe haven for customers, as everyone used to think. A bank's most profitable customers aren't those who are simply rich, but rather the millions of people whose paychecks fall a little short and who carry their debt from month to month. Time to pull it all together and answer the actual question. How much money do you make if you do this right? Let's run the math on two realistic versions of your bank. Option 1, a small community bank. You bring in your $20 million in regulatory capital, plus another $500,000 for the charter and consultants. The first 3 years, you're operating at a loss. That's normal. Almost every new American bank loses money before deposits and loans scale enough to cover the fixed costs of running the place. By year 5, you're sitting on about $350 million in assets, mostly loans and securities, funded by customer deposits. Using that same 4% net interest margin, that's around $14 million a year in net interest income, plus another $2 million from fees and card products. After staff, branches, technology, and regulatory costs, you walk away with around $4 million in net profit per year. And here's the part people don't talk about. Most small American banks never grow much past that. Build it for 10 years, sell it to a regional player, and walk away with roughly 4 times what you put in. Option 2, a large regional bank. We're talking $20 to $30 billion in assets, multiple states, hundreds of branches. A bank that size pulls in around $700 million to $1 billion a year in net interest income, plus hundreds of millions more from fees, card products, wealth management, and treasury services. After all the costs of operating at that scale, you're looking at $400 million in net profit annually. Not bad for an industry that gets to sell people their own money back.